Is tail risk hedging difficult? Have you ever wondered how investors protect themselves from rare but severe market downturns? This is where tail risk hedging comes into play. But is it really as challenging as it sounds? Let's break it down. Tail risk hedging is all about shielding a portfolio from those extreme market events that can lead to significant losses. These events are rare but can have a huge impact on investments. The first hurdle is the rarity and unpredictability of these tail events. They often occur unexpectedly, making it tough to time and size your hedges correctly. Traditional models assume that market returns follow a normal distribution, but real markets often show what is called fat tails. This means extreme events can happen more frequently than you might think. Next, we have the cost of hedging. Tail risk hedging usually involves buying out of the money put options on indexes or stocks. These options can gain value during market crashes, but they often lose value or expire worthless in normal or rising markets. This is similar to paying for insurance that you may never use, which can be quite costly over time. Another factor is path dependency and performance variability. The success of a tail risk hedge can depend on how a market downturn unfolds. For example, sharp crashes like those in 2008 or 2020 can lead to big payoffs from options-based hedges. However, if the market declines gradually, those hedges might not perform as well. This variability makes it tricky to decide when to maintain those hedges. Then there is the complexity involved in designing an effective strategy. Understanding options pricing, market dynamics, and volatility is essential. Some investors combine long put options with U.S. Treasury holdings to balance costs and protection. Managing these hedges also requires knowing when to buy or sell options based on market volatility, which can be counterintuitive. Liquidity is another consideration. Options markets can vary in liquidity based on the underlying asset and location. For instance, options on U.S. equity indexes tend to be more liquid and easier to use for hedging compared to options in some Asian markets, where liquidity can be limited. Lastly, tail risk hedges often have negative expected returns over time. Since markets generally rise in the long run, and these hedges only pay off during downturns, they can lead to negative returns most years. This makes it hard for investors to justify the ongoing costs and stick with the strategy during long bull markets. In practical terms, tail risk hedging requires balancing the costs of protection against the potential benefits during rare crises. Investors must accept that while hedging may reduce returns in normal markets, it can prevent catastrophic losses during those tail events. This trade-off, combined with the unpredictability of tail events, makes tail risk hedging a challenging strategy to implement effectively.